I'm sure you paid attention to the earnings from not only the alternative asset managers, but also the big banks. We're seeing comments about tightening of standards. Is that it sounds like it's a good thing, but what does that mean for generally the private credit industry, a space that you obviously are in?
Yeah, look, there is talk about tightening of lending standards. It's not that obvious to me. The reality is that there has been a lot of money raised by private debt funds. There's a desperation to deploy ever-growing pools of capital. And most of that money is being deployed against private equity groups. One thing private equity groups are very good at is extracting favorable terms from their lenders. So we've seen things like the J.Crew blocker being inserted into loan documentation as a potential indication of tightening lending standards. That's not what I'm seeing. What I'm seeing is a race to the bottom when it comes to lending standards, when it comes to covenants, and when it comes to pricing.
Yeah, as you mentioned, there was actually an article out a few days ago talking about a lot of these alternative asset managers in a race to the bottom when it comes to private credit, just because, these deals are so lucrative for those firms. Now, you mentioned a very colorful term, a J.Crew blocker. We're going to explain this to the audience. It's basically something that prevents companies from shielding their valuable assets, whether it be IP or whatever else, in a subsidiary to protect it from creditors, kind of named after a loophole. We're showing it right now that J.Crew, the retailer, the sweater maker, actually used to deal with its creditors. Eventually, it not only shielded its assets, but it was able to take out more loans from other creditors. That's almost half of private credit deals, 45% in Q3, big jump year over year. What does that say? Is that simply a precaution, or is that a sign that maybe a lot of these lenders, they really think that some of the people that are borrowing might try to do something deceitful or, below board, I should say?
In reality, for me, it doesn't say much at all.
Really?
So what J.Crew did was they extracted intellectual property from their security group. That shouldn't happen. So to put in a J.Crew blocker and to think that that's an indication of lending standards, for me, is too simplistic. It should never have happened to begin with. And there are other ways that borrowers are continuing to extract valuable assets from the security group that should be to the benefit of their lenders.
All right. Private credit traditionally has been used for like middle market companies, not for huge deals, not for small deals, but kind of in that middle market was the sweet spot. As we go ahead, after we've seen have gotten through this earnings season with no more, at least I haven't seen any more cockroaches. I don't know if you have. Where do you see the private credit industry going? Is it going to go to bigger and bigger deals? Because we've seen a company like Meta take out $25 billion in bonds to secure capital. Where does private credit go from here?
Well, for sure, private credit is more focused on larger cap transactions right now. You can see that in the fundraising patterns. Far easier for the large cap private credit groups to raise capital than the mid-market direct lending groups. So you will continue to see the brand name groups, Blackstone, Apollo, continue to commit a lot of money to larger deals. That's what they're looking for.
Is that what you're doing? Are you looking for bigger and bigger deals?
We are a specialized group. We are looking for companies that need a partner in their capital structure, not a commoditized lending group. So we are far more specialized.